Hello everyone, welcome to the first episode of the Great Investor series, where we introduce some of the world's greatest investors to you so that you can help understand the investing principles which made them so successful at what they do, and then to also help you apply these principles to your own investing journey to help you become a better investor. This episode is brought to you by the Asia Report, where we're dedicated to helping you learn the habits and success patterns of some of the best investors in the world so that you can take control of your own investing decisions and to shape your own financial freedom going forward in the future. Do remember to check us out at theasiareport.com and sign up to our mailing list where you'll get exclusive updates from us, interesting case studies from around the world, and of course, invaluable information that will help you become a better investor with time. So today we're going to be talking about Howard Marks, one of the top investors in the world. He founded Oaktree in the 1990s, one of the premier firms in the US that specializes in dealing with distressed and debt. And he manages tens of billions of dollars. He has one of the best track records in the industry. And to give you an idea of how prominent he is, Warren Buffett, one of the world's richest individuals and one of the best investors in the world, says, "When I see the memos from Howard Marks in my mail, they're the first thing I open to read. I always learn something, and that goes double for the book." So for those of you who are interested after this video, Howard Marks actually publishes his memos for free, and he has done so for the last 20 years or so on his website, where he talks about his own investing insights. He talks about cycles. He talks about market psychology. It's all free. It's all out there. And he's actually compiled it into a book by topic called The Most Important Thing, which I highly recommend. And he has also a new book upcoming which talks about market cycles, which is out probably later this year. But without further ado, let's talk about three things which I think I've learned a lot about Howard Marks specifically, and what I've distilled from his own investing principle. And the first thing is something that most people are probably innately aware of. And that is that market moves in cycles, right? It does not move in a linear fashion. You always hear people talking about recession. You always hear people talking about upturn and downturn, boom and bust. This whole idea of cycles. And Howard Marks says, the rule number one in investing is most things will prove to be cyclical. And rule number two is some of the greatest opportunities for gain and loss come when other people forget rule number one. And this is really a play on the rules that Warren Buffett has given. And it goes something along these lines. Warren Buffett says, the first rule of investing is not to lose money. The second rule about investing is not to forget rule number one. So this is a little bit of cheeky reference to that. But what Howard Marks is trying to get at here is that good times don't last forever. But on the reverse side, recessions, bad times, depressions also do not last forever. It's very easy to become a naysayer, a pessimist, someone who always is saying bad things. But there's always a silver lining in the clouds. Spring always comes after winter. And what here is trying to say is that trees don't grow to the sky. At the same time, very, very few things actually go to zero. And he's alluding to the market cycle. Now, where most people will be familiar about this is actually in the property cycle. So this is a picture of the private residential property price index in Singapore since 1993 until today, until about end of 2017. And you can see very distinctively that you have several booms. You have the bust, you have your boom again, a very, very long, cold winter for property, the boom, the bust, the boom, the bust. And what I'm trying to get with this is that a lot of people always allude to this whole idea of there being a property cycle. Prices are either rising very highly or the market is simply dead. And this is the whole idea of cycles that we're talking about. Now, property cycle is something that I talk a lot more about. I'm not going to cover so much here. I just want to draw your attention to this whole idea. There are many, many different cycles. There are property cycles. There's the stock market cycle. And you can even think about it in terms of jobs, right? I think a couple of years back when the Great Recession hit, a lot of people thought that, I want him to study in a professional degree. I would like him to be a lawyer. They started sending their kids overseas to become lawyers. Fast forward a couple of years now, what was once a very lucrative job, which paid quite high salaries and there was a relative undersupply of lawyers, has suddenly become a situation where there's an oversupply of lawyers. There are too many lawyers out there, your wages are depressed, it's hard to get a job even though you have a professional degree. So that's an example of a boom and a bust. You had a boom period where there were a lot of people who were rushing in because of the perceived benefits of employment, of the high salaries. And then you have some sort of a bust in that people are starting to realize that, hey, maybe it isn't worth it to pursue this career. So this is the whole idea of cycles which keep repeating themselves again and again and again and again. Now, the second thing, which is very, very related to financial decisions and something I believe strongly about, is the whole idea that leverage is a two-edged sword. Now, Howard Marks says that leverage magnifies outcomes, but doesn't add value. And let me just kind of explain that a little bit. The problem of leverage is very, very simple. Leverage doesn't change whether you are right or wrong about your decision. So let's say you buy a property, you think that property prices are going to go up. Even if you buy more properties because you're leveraging up, it's not going to change the outcome of whether property prices rise or not. What it will change will be the impact if you are right or wrong. So if you're right, the property prices go up, you're going to make more money. But if you're wrong, you're going to lose even more money. It's just simply a multiplier effect on whatever the outcome of the decision is. And what I do not like about leverage, especially if you're investing in stocks, so I always like to say that when it comes to the stock market, borrowing money on margin is always an extremely dangerous game. When the game is good, markets are rising, people leverage up, they're making a ton of money. The problem is that when you're dealing with an instrument that volatile, leverage becomes extremely dangerous because when prices fall, you get margin called. Essentially, you're forced to sell your stocks at a loss at the worst possible time, and your brokerage will come in and seize whatever cash you have or ask you to top up, and you find yourself in a losing position. And that's why I would say leverage is dangerous. There are good strategies for making money with leverage, don't get me wrong, but if you're a beginner investor, you're someone not familiar with the markets and all that, this is not a strategy which I recommend. And that's why Howard Marks is trying to say the leverage is a two-edged sword. It's not good or bad intrinsically, but it's something that can be used for or against you. But if you don't know what you're doing, it's like giving the car keys to a Ferrari to someone who's just learned how to drive. It's not a wise decision. So I'm going to end that point on leverage right there. So Howard Marks also talks about something which I always like to say, that the future is unknown, but you can still prepare for it. And he goes on to say, the future does not exist. It is only a range of possibilities. We have to understand that most outcomes will be determined by luck. And he goes on and says that you can't predict, but you can prepare. So this sounds a little bit esoteric, sounds a little bit kind of wishy-washy. Let me try to break that down into something a little bit more specific. Now, let's say you have an important job interview lined up. Maybe it's at 9 o'clock. And you say that you don't know what the traffic is going to be like. You don't know if there's going to be an accident. There's so many different things that can happen. Maybe you have bad weather. Maybe you have a subway breakdown. You don't actually know what the future is. It's just a different range of outcomes. And there's only one final thing which actually happens. And there's no way for you to know with great certainty what is going to happen. Now, what he's saying here is that when it comes to investing, it is exactly the same thing. Investing is more art than science. No one knows what the future is specifically. Just think about how much problem we have even trying to predict the weather as it is, and you get an understanding of how complex and how random and variable investing is. However, what he's saying is that even if you don't know whether there's going to be a traffic jam, even if you don't know whether the subway is going to be working or not, you can still prepare for bad outcomes or adverse outcomes by simply going earlier. If your appointment is at 9 o'clock, you think it's going to take you half an hour to get there, but it's going to be one of the most important interviews of your life. You leave at 7:30 a.m., you leave at 8 a.m. You start to create a margin of safety for yourself, and in that way, you can start to prepare for bad outcomes. Does it mean that nothing bad will happen? No, but you start to insulate yourself by creating a margin of safety. And so I come to this idea of margin of safety, which is something that's thrown around a lot. The term was coined by Ben Graham. So for those of you who don't know, Benjamin Graham is actually Warren Buffett's teacher. I think Warren Buffett needs no introduction. He's one of the best investors in the world, and also coincidentally, one of the richest people in the world. And he's really Benjamin Graham's student. And Benjamin Graham coined this idea of margin of safety. So what is margin of safety? Rather than explaining it in investing terms, let me speak to it through analogy or story. So let's say there was a river outside your house and you had to build a bridge across it. Now the challenge is that you don't actually know how many people are going to cross the bridge on any given day. Maybe you think there might be 5 people, there might be 10 people. You don't really know. You have to inbuild a margin of safety into the structure of the bridge. And you say that, if you think there's a maximum of 20 people that might cross the bridge, I'm going to make sure that the bridge can actually support 30 or 40 or 50 people. In that way, you don't need to be precisely right. You can be imprecisely wrong, and it still wouldn't matter because you've inbuilt a margin of safety. Very, very similar idea to simply going early to an important appointment rather than trying to cut it close. That is the whole idea of margin of safety. And trying to put it in context of investing now. Let's say you're investing in a company that pays dividends. Let's say it pays 15 to 20 cents per year. You want to make sure that the company is also able to generate at least the same amount of money as dividends, because dividends can really only be paid out of your existing cash flows or your existing cash reserves, and you want an additional margin of safety. So put it very easily, if you want to lend someone $5,000, you want to make sure that he's earning at least $6,000, $7,000, $8,000, $9,000 or $10,000. You don't want to be a situation where he's only earning $3,000 and he wants to borrow $5,000 from you. And the more money he earns, the bigger your margin of safety and the higher the likelihood you're going to get your money back. So in the case of company paying dividends, the more money it earns relative to the dividends it's paying out increases your margin of safety. And so that's what Howard Marks is really trying to say. He's trying to say that even if you have a great company that's been around for a very, very long time, it's paying good dividends for many years, you don't really know whether it's going to be around the next 5, 10, 15, or 20 years. But if you're in a situation where the company is paying a 20-cent dividend and earning $1, you are in a much better position than in the case where a company is earning 20 cents and is also paying out 20 cents at the same time. So that really wraps up the idea of margin of safety. It's a very, very simple concept, but it's an extremely powerful concept that really sets value investors apart from other investors. You're trying to pay 50 cents for a dollar bill as opposed to trying to pay $1 for something which you think is worth $1.10. You're trying to create the biggest margin of safety as possible. So with that, I'm going to wrap up this short episode on Howard Marks. If you have any questions, if you have any feedback on this episode, which is meant to be a short introduction to Howard Marks, do email me at jun@asiareport.com. I'll leave a comment down in the comment section. With that, I'm going to end this episode, and thanks for tuning in.